What's going on, guys? Kenney Conwell here. And if you're on this video watching this right now, you want to know how to legally and ethically avoid paying tax. Now, there's no way, let me just say this up front. You're going to have to pay a little bit of tax, but you can significantly reduce the amount of tax that you're going to pay. And in this video, I'm just going to break down some high-level key concepts you want to consider when you're going down this process. Now, the first thing I want you to understand, there is a huge difference between tax evasion and tax avoidance. Tax evasion is illegal. You can go to jail for that. Tax avoidance is what the wealthy do, and it's just being smart with your money. Now, let me give you a quick background so you understand that I'm not just making any of this stuff up. So I've been in the insurance, financial, and investment industry since 2007. As of this video, it's 2021, so it's about 14 years of in this industry. And I have a successful seven-figure company, and I paid more in tax because I didn't understand this process, thinking that a CPA knew all of this stuff when I made $550,000 than I did when I made over $1 million, right? So the concepts I'm going to cover really quickly is really about tax avoidance and not tax evasion. So the very first thing you want to consider, especially if you are an entrepreneur, number one is your entity selection. That is the very first thing you want to make sure you set up correctly. Now, many people don't even have entities set up. And the ones that do set up entities, they typically default to an LLC. Now, LLCs are awesome. I'm not here to talk about LLCs and business entities, but generally speaking, you want to set up a business entity. Now, you can, for clarity purposes, the general entities is a sole proprietorship, which I don't recommend you have a sole proprietorship because there's no liability protection. You can do a partnership, which technically is an entity. And typically it's a partnership between you and somebody else or other partners. You have limited partnerships, general partnerships, professional partnerships, but you can do a partnership to keep it simple. You can do a corporation, and then you can do the LLC, which stands for Limited Liability Company. Now, I'm going to spend a little bit of time on an LLC, and then we'll get into some other tax strategies about tax avoidance. Now, because we pay tax not on revenue, we pay tax on profit. And profit is our take home, and we want as much profit as possible to divert as many taxes as possible, period. So let's just say you choose to be an LLC. Many people don't understand, and I'm glad I'm explaining the LLC last, because an LLC can be taxed. Guess what? As a sole proprietorship. An LLC can be taxed. And for our pretense purposes, sole proprietorship, Schedule C, this means it flows through from the profit to your personal tax return, right? The LLC can be taxed as a partnership, right? The LLC can be taxed as an S corporation, which means the profits flow through, but you avoid self-employment tax, or the LLC can be taxed as a C corporation. Now, I'll spend a little bit of time on C corporation. When you are a C corporation entity itself, then the corporation pays tax, and then you as an individual pays tax on the money that you received from the corporation. Most people refer to that as double taxation. But depending upon how you have it set up, there's still ways that you can still defer taxes. Now, the reason why I'm bringing up the LLC is because generally speaking, many people choose to be the LLC, but they never make the election at the entity level to let the IRS know how you're going to be taxed, not on the revenue, but the profit of your corporation. So generally speaking, it makes sense to be taxed as an S corporation, and you have to make that election with the IRS. So just because you form an LLC does not mean that you're going to be taxed as a C Corp, S Corp, partnership, or whatever. You're going to go through the default status. That being said, what you want to do is when you set up your tax ID number, at that point, you inform the IRS or whoever's setting up your EIN, do you want to be taxed as an S Corp, C Corp, whatever the case is, partnership? But let's just say you didn't do that. Well, you can file a S corporation election for an LLC. Now, the reason why I'm spending a lot of time on entity selection before I get into like the tax avoidance versus tax evasion is because you pay tax on profit. So if I choose to be an S corporation, right, I have to pay myself what's called a reasonable compensation. Now, this is where the additional tax strategies are going to come in. Now, if I pay myself a reasonable compensation for my job, let's just say my job is the director of marketing, and my profit on my business is going to be, $500,000, right? Well, what I can do is pay myself a salary of, let's just say, $80K, and then I don't have to pay myself in salary all of that profit. I can say, hey, look, what I want to do is do what's called a K1, because when you pay yourself a salary, there's something called self-employment tax. And self-employment tax, generally speaking, is about 15.2%. So you have to pay your federal tax, self-employment tax. So that's why when you become an S corporation, you still have to pay the self-employment tax as an employee of your company. Or if you 1099 yourself, you still have to pay yourself self-employment tax. But when you K1 yourself, that's the big thing here. K1, you completely avoid self-employment tax or that 15.2% tax, which is why people choose to become S corporations. That alone, right? Depending upon your profit, like this example, the profit would be $420,000. You would save 15.2% if you're going to take all that money in a K1 that year. Think about that. That's huge. That's one strategy. Now, the second strategy that you can do, well, the second way that you can avoid tax is making sure you have the proper retirement account set up. Many people don't know about SEP IRAs, 401ks, solo 401ks. So there's different monies, different ways that you can defer tax. So instead of me paying the money to the IRS, what I can do is say, hey, look, I've got this $420,000 profit. I can put up to 25% of my profit away in that retirement account, up to, I want to say it's $55,000 if it's a SEP IRA. So I'd rather put $55,000 in my retirement account to defer or reduce my taxable income versus pay it to the IRS. Forget that. So that's the second strategy, retirement accounts. The third strategy to legally reduce the amount of tax are deductions. Now, there's so many different deductions that you can use. One of the common deductions is the home office deduction, right? That's a common one, like making sure that, hey, look, if you work from home, you can deduct a portion of your rent, your utilities, and all that as an example. Many people don't know that they can hire their children, pay their children a salary, and then that becomes a deduction, right? Many people don't understand that you can hire, well, I just said your kids, but you can hire certain people in different economic situations to defer tax. So what I'm saying is that third way is making sure you have the proper deductions to reduce tax. The third way is depreciation. Depreciation. Now, many people, like in a previous video, I talked about buying a vehicle in your company's name. Well, there's three reasons you do this. I covered that in that video. Take a look at it. But in this scenario, buying a company car makes sense because you can take advantage of depreciation as a write-off, right? So if I'm depreciating a piece of equipment, what that means is it reduces the amount of tax I would have paid to the IRS, but I got the vehicle today, right? So instead of me giving that tax to the IRS, I got a car and now I can ride around and then I can continue to write that off. So that's a really, really powerful one that many people just don't take advantage of. They don't really understand how it's structured. A really new one, a recent one is the Rnd Tax Credit. And really, I won't get too far into the weeds of this, but if you're like a software developer or you're doing something that's IT related or tech related where you're developing something, you can get a tax credit for doing that, right? So those are some really, really common tax reduction strategies that you can do. The biggest one is making sure you have the correct entity set up, making sure you have the right deductions, you're taking advantage of all the deductions that you can take, that you can do. And then there's different credits depending upon if you have employees, if you have people, certain types of people working for you. But another one too, and another common one is real estate. And depending upon how you have your real estate structured, right? And then making sure if I'm gonna do depreciation, or if I'm purchasing this vehicle, this building or this piece of real estate property, how can I, get the depreciation from this, right? Again, there's a depreciation from that particular property. And then one other one that just came to mind, like literally just popped up in my mind, is not just with the depreciation with real estate, but also making sure let me make sure I want to give you guys an accurate thing. It's depreciation with real estate. It's not 1035 exchange, but it's just another strategy in which you can do to reduce the taxes that you would have paid. It's slipping my mind. But the biggest thing I want you to understand is those are the different ways that you can avoid tax. But the other part of this, the oil and gas, that was it. So if you invest in certain oil and gas properties, you can defer tax. And when I say properties, if you're buying straight up oil and gas and you're holding it, that's a way to defer tax. And lastly, it's two more. If you happen to move to Puerto Rico, you can, defer paying tax depending upon if you're living there or if you're not living there and all that good stuff. That's another strategy to defer paying tax, because the whole purpose of this, the reason why you're doing this is because you're strategically leveraging the IRS tax code in your favor, so that way you can significantly reduce paying the amount of money in tax. The ultimate thing that you will want to set up, which many people don't get this, is making sure that if you can, in some scenarios, have the proper entity, retirement accounts, the deductions, the real estate, any type of depreciation from when I say depreciation from real estate and or other equipment. And then the last one that just popped up in my head again, and here it is understanding tax loss harvesting with investing, right? So you may have an investment account that took a loss, right? Or took a gain. You can defer tax in there because you have capital gains tax and then you have earned income tax. But you have short-term capital gains, long-term capital gains. So depending upon if you lost money in the market, you can carry those gains over to reduce your taxes. So I know I went into the weeds of all of this stuff, but the biggest thing I want you guys to understand is when it comes to tax, you don't unnecessarily have to pay. So, and don't just go off what your particular CPA or your accountant is doing. There is a difference between tax planning and tax preparation, right? Tax planning is forward looking. You're looking about, okay, I'm projected to make, this much money this year profit. What are some things I can set up in this calendar year to ensure that I reduce the amount of money that I pay tax going forward, because I don't want to stroke that big check to the IRS. Versus tax preparation, they're just looking at the past and saying, okay, here, give me your returns. Let me this. All right, this is how much you got to pay in tax. And the unfortunate part about it is a lot of the tax saving strategies that you can take advantage of have to happen in that calendar year. If you don't set them up in that calendar year, you can't take advantage of them when you're filing your taxes. But here's the dilemma. You're generally filing your taxes the next year. So if we're in 2021, you're filing your 2020 taxes in 2021. And if you didn't set all that stuff up in 2020, you're going to be looking around and then you have to pay this unnecessary bill to the IRS. So that is the difference between tax, how to legally and ethically, just some key strategies to reduce the amount of money that you pay in tax. If you want to learn more about specific strategies as an entrepreneur, click the link just below this video, book a call with us. We'll walk you through step by step exactly how you can significantly reduce the amount of money you pay in tax, and then also position yourself to not pay the IRS, but build your own wealth.